The gentleman from Wisconsin, Mr. Stile, who's also the chair of our subcommittee on digital assets, financial technology, and artificial intelligence. You're recognized for 5 minutes.
Thank you, Chairman Hill. Thank you, Chairman Powell, for being with us today. I want to dive into two actions the Fed's recently taken to get a little additional color on. Yesterday, the Fed announced that reputational risk would no longer be a component in bank exams. I viewed that positively. I viewed the reputational risk as often being a catch-all for political bias. I think it's positive to depoliticize bank exams and instead focus on the core and measurable risks. Could you provide color as to whether or not any new information came to light that led to the decision of the Fed to remove that yesterday?
I'm not aware of any new information. No, we just think it's the right thing to do, and of course made an announcement on Monday under Governor Bowman's, Vice Chair Bowman's leadership.
Why would it not have been done previously if it's the right thing to do? I agree with you, it's the right thing to do. Why was it? Any timeline as to why that was done yesterday versus previously?
No, I think this is a problem that we came to understand as a problem over the course of the last couple of years, and began considering what's going on here. We're hearing a lot of reports of debanking and that sort of thing, and over the course of really 2024, came to the view that this was a serious problem that we need to address, and we've said that publicly, and now we're doing this, and so are the other agencies, by the way.
I appreciate you taking that action. I do agree that there were real political bias in some of those exams, in particular as it related to regulated entities engaged in the digital asset space. Let me shift into the digital asset space if I can. Another action recently taken by the Fed, the Novel Activities Supervision Program was ended and withdrew several statements on digital asset related risks that deterred bank involvement in particular. You in the Fed and others in the Fed have spoken positively about the House and Senate work to regulate stablecoin in particular, a real opportunity to dollarize the globe and be a significant purchaser of U.S. Treasuries. Following that action by the Fed, have you seen an identifiable shift in banks or other regulated entities as it relates to engagement in the digital asset space?
You know, I wouldn't be the one to be picking that up first, but what I do see is a very significant change in the tone, and it really does reflect evolving thinking and the evolving status of the crypto industry. And I would expect over time we'll see more activity.
How is the Fed evaluating and overseeing banks or other regulated entities that are in the digital assets or crypto space?
So our view is that banks get to decide who their customers are. That's not our decision. And so banks are free to provide banking services to the crypto industry, to crypto companies, and banks are also free to conduct crypto activities as long as they do so in a way that is protective of safety and soundness.
Thank you very much. Let me shift gears because I want to give you just a little bit of an opportunity to comment on the housing sector once again, but give you a little freedom here to speak to that area. You correctly are trying to balance inflation and price stability. But also higher rates have a significant impact on the housing market, as shelter and housing costs are a significant driver of why many families can't afford the things that they need. Can you provide color as to how you're analyzing the impact that housing and shelter costs have on families and on inflation with your desire to maintain price stability at the interest rates that is currently set by the Fed?
Sure. So, we realize that people are feeling high housing costs and high financing costs. In terms of inflation, we look at something called owner's equivalent rent and rentals, and that's meant to capture both rented housing and owned housing. And it's been very sticky. It's been one of the stickiest parts of inflation. I'm happy to say now it actually is coming down quite regularly. That's very good news. That's been the part, really it's been the service inflation that's been stickier than other parts of inflation. So that's good news for people, I think, and it is showing through into measured inflation now. Again, in the long run, the best thing we can do is restore price stability and let the market work. Even then, though, we're still going to have a housing shortage.
What data do you think is leading to the reduction in the rent equivalent?
I just think it took time. So the thought is when you would think that if rents come up every year, you would think it would take 1 year or 2 years for a lack of growth in rents to show up in a lack of growth in housing prices. It turns out it takes 4 years or 3 years. If you're an existing tenant, it's a complicated thought, but if you're an existing tenant, you don't actually catch up the way you would if new tenants came in. And so that's made the measurement of inflation stickier. But I'm happy to say we've been through that period now, and we are really seeing now housing services inflation pretty close to where it was when inflation was solidly at 2%.
Thank you. I yield back.